Every founder selling a business suddenly hears quality of earnings from their sell side advisor, but here's what it actually means. Much like when you're purchasing a house and you need to get an inspection of the house to make sure everything is as expected, you need to do the same thing with financial diligence and a financial inspection on your books and records to make sure the business that the buyer is acquiring actually makes the amount of revenue that they are underwriting as part of the process. And so they're just generally using this process to make sure that they understand the financial risk and actual results of the company that they're acquiring. Yeah, here's what to fix in your books before you try to sell. The number one thing that I see time and time again is that reconciliations are not done on the balance sheet, which then opens up a lot of other questions in an accountant's mind. So make sure that the cash balance you have in your records actually matches the cash balance of your bank statement, and same with payroll and many other kind of components, just to make sure that there's no differences between the various data sources. This is what most often blows up a deal or drops your price. The business owner doesn't actually understand their books and records and does not really track things according to how the revenue is actually earned. So oftentimes, when a company actually receives money is not actually when the buyer will count that as earned, based on the fact that maybe the service hasn't been completed. How early you should start prepping your books for a sale is generally as soon as possible, and as soon as you know that that's probably a greater than 50% chance likelihood is the threshold I like to use. And I would say getting 2 years of clean books is really important to this process. You can get away with 6 months or a year, and that's certainly better than nothing. But I think the cleaner your books are, the easier this M&A process is going to be for you. What to have ready before you even think about selling is obviously a clean set of books. But the other thing that people don't often think about is having standard operating procedures and having backups for their most critical processes. So for example, roofing contractors, when they go out and have to estimate a job, if there's only one individual in the business who can estimate that job, that's a bottleneck on the business that really limits the value. How messy books quietly drop your valuation, even when the business is good. Really, the messy books just increase the amount of risk to the buyer. And so the amount of the multiple that they're going to give you decreases, because now there's a greater spread of what could occur once they acquire the business. The timing mistake that quietly costs owners pretty big is using their own attorney instead of getting an M&A-specific attorney. That's really something where now you're playing from a totally different ball game and really just adds friction to the process. What a 13-week cash forecast tells you that your P&L can't is how soon you will accumulate or lose money in your actual bank account. So a P&L is theoretically how much money a business makes, but as most business owners know, that's not exactly the same as what flows in and out of your bank account and what actually gets payroll paid. So many people forget or do not understand the cash conversion cycle, it's called, of their business, and how quickly it basically takes in their business to make back their dollar and then their profit. Where AI actually helps in finance and where people still get burned, I would say with AI, it's actually helping people in finance with fine-tuning their models and doing formula checks and being a good kind of thought partner for the finance function. However, people that are overly reliant on it to do really complex tasks often miss inaccuracies in the data. So really taking things piece by piece is an important way to use AI effectively, but not get any mistakes or hallucinations. So the one automation that saves our team the most time is using the application that we created, Finsider. It's really a series of lots of little automations that work together in concert to essentially instantaneously create FP&A dashboards and quality of earnings analyses. So we've slowly automated piece by piece, and now it's brought all together in one tool where most finance leaders can actually use this to automate a big portion of what they're typically doing in Excel spreadsheets. The danger of automating a bad process is that your data is going to be inaccurate and that you're going to be relying on data. There's an old adage in finance, garbage in, garbage out, and that is more true and important today in the AI era than anything else. I think everyone hears about prompt engineering and how important it is to ask the right questions and lead the AI in the right manner, but not as many people talk about context engineering. What data are you giving the AI? And interestingly enough, are you giving it too much data as well? In which case it can kind of drown and give you, bad answers from that as well. The most common tax mistake I see growing businesses make is not thinking about the tax implications of how they're going to form their entity and their ownership structure, which really is something that has a lot of downstream effects on everything else they do. So the biggest way to avoid this is to actually talk to your CPA before enacting any formation or equity changes of any kind. LLC or S-corp, that's an interesting question in terms of when to go with each and when each would save you some money. I would say the S-corp has a little bit more regulation, could be a little bit more advantageous in saving you money, especially if you're a small team and you're not expecting to grow quite as much. Then that's a really good time to use an S-corp if this is your main source of income and you feel comfortable with, the limitations that an S-corp puts on you, whereas an LLC is just the max flexibility of all of the formations. Would I study accounting if I were starting today? That's a great question. I don't know if I would, just because I think I'm more entrepreneurial than the typical accountant, and so maybe accounting wasn't the right profession for me to start with, and I made it the combination of that work. But I would say it's really important for early stage accountants right now to really understand data and how it all connects together. I think that more than anything is where accounting is going, is how do you account for larger and larger volumes of data? The skills that matter more than 10 years ago, even 1 year ago, is prompt engineering, understanding AI, and how to leverage that responsibly. And I think that's really the key, is how do you leverage tools like Finsider that puts good guardrails on what you're doing and maybe fine tunes the model and is still secure for client information. That's really important, is to know all the tech landscapes and how to put these various automations together. So, the number one thing I tell our team at the services company is, we are the glue between all of these new up and coming tools. And that's really the modern CPA's job. Being a dad has really shaped my entrepreneurial journey, especially when you start to think about your time as the greatest asset more so than money. So, one thing that I religiously do is from 5 to 8 p.m. Eastern, I am completely unplugged from my computer and my phone as much as I can be. And that is dad time for me to spend with my kids and stay engaged and really be there for them while still, being a responsible business owner and getting a lot done before and after that time frame. So, just carving out in that time management piece is really important to me. That is probably the hardest question of all of them. I'd say being a dad is probably a little bit harder intellectually, and running a business can feel like you're running in a hamster wheel sometimes. So I think it depends on the day. It's probably a different answer 3 out of 5 days of the week. I really feel that our accounting prowess helps us with business, because accounting is really just the language of business. And if you know the basics of how to account for things and you have that financial discipline, it really helps with all the other aspects of entrepreneurial journeys and endeavors, because now you're able to see things from the numbers to the story and how they coincide. And I think that's a really big part of both M&A and where entrepreneurs are going in their journeys, is understanding the data and the story and tying it all together.